Good afternoon, everyone. 1, 2, 1, 2, 1, 2. 1. Okay, we'll use that microphone. That's obviously a better microphone than the other one. Welcome back, everyone. Hope you enjoyed your afternoon tea, and we managed to steal another 4 minutes out of Stewie. So I think that was particularly good. Right, we're going to settle back and we're going to try something we call a little fireside chat. So let's dim the light, shall we? Get us all in the mood. You can imagine a nice crackling fire, maybe a Canadian fire next to a ski field somewhere, Jasper, somewhere like that I like to go to. And I'm going to invite these two fellows up here. You can imagine them, they've just come off the ski fields. They've got a glass of, what would you have in your hands, fellows? A nice whiskey on some rocks. You've got water, which is lovely. So Margaret Rivers Pinroy. Okay, so the fellow at the front there, the chatty one, he is the portfolio manager of Nuclear Energy Opportunities Fund for Tribeca. Would you please welcome Guy Keller? There we go. And the reason that I made the Canadian reference is basically we're off to Canada. We're going to hear from Cameco, and that's the largest global providers of the uranium fuel, which is needed to power our clean air world. And this is Grant Isaac. Would you please make Grant welcome, everyone? So Grant is the Executive Vice President and the CFO of Cameco. So I'm going to grab these two microphones here. I've got microphone number 2 and microphone number 3 audio desk. You guys, all you need to do is push the button, toggle on the side up, and I'm going to leave you all in Guy's very capable hands as he guides our intimate fireside chat with Cameco. Please make them welcome, everyone.
Thank you. It's lovely to be here. A fire is probably not what we really need in Singapore with the humidity out there, but although if anybody was here this morning with that aircon, you probably needed a fire. It's wonderful to be here. I've spent 6 years up here working, and it's great to be back. What's even more exciting is to be here with Grant, who's graciously given us some of his time coming over from Canada, and not at a uranium or a nuclear conference. You know, it's we're out of the echo chamber of everybody nodding along with us because they get the nuclear and the uranium story, and we might have to sell ourselves a little bit here, Grant. So I guess we are here at a future-facing commodities conference, and obviously we've decided that uranium is part of that future. Maybe if you could just give us a little bit of a rundown as to why uranium fits into the decarbonisation themes, the electrification themes, and what you as Cameco are doing in that sector to progress uranium as something we need going forward.
Yeah, happy to do that. And just want to start with a thank you to the organizers, as well as those of you that are still in the room this late in the day. Really appreciate this opportunity. And thanks to Guy as well. I think you probably already know this, but he's been following the space for a long time and has been a leading voice among the investor community on the opportunity that exists in nuclear, in the nuclear fuel cycle, and then of course in the uranium component of it. So just a couple of comments, and then we'll flip it back to your questions. But we're pretty excited about where the nuclear energy industry fits in after years of being kind of a neglected part of the clean energy story. Just recently, we have policymakers all around the world scratching their heads and saying, you know, I wish somebody would invent a technology that's 24-hour, completely dispatchable, completely carbon-free, secure, and clean. And some brave person says, well, actually, it already exists. And then nuclear starts to claw its way back into the policy toolbox. And it's done it at a time, of course, when energy security has really taken the forefront. And so we've just seen this complete change in the demand outlook for our sector. It used to be, you know, pretty steady demand, but you had to wait for new builds to come along. But now we're saving reactors that we thought were going to shut down, because keeping the clean energy you already have going is pretty important. Country after country no longer phasing them out. And then in the medium term, We're extending the life of reactors that would have hit their normal operating life. So country after country following what's been done in the United States. And then, of course, 57 big reactors under construction, and a really interesting focus on small reactors now has all created a demand outlook that we've never seen before in our industry. And it's pretty exciting.
Yeah, I guess that's interesting because from our perspective as a fundamental resource stock pickers, we saw that big supply deficit, primary mine supply deficit that has been problematic for the best part of a decade. And, to your point, 57 reactors being built. It's one of the biggest reactor build programs we've seen in decades. And it's not just China. There's a dozen or so countries pursuing that. 57 reactors is the equivalent of another McArthur River mine, one of your tier one assets, running at nameplate capacity to fulfill the demand that's coming in the next 5 years from these new builds. Yet we're unable to fill the supply deficit at current prices with current projects for the existing 450 odd reactors. I mean, can supply respond, and what does it need to be able to fill that deficit?
Yeah, one of the biggest surprises, but shouldn't have been, to the supply side of the business is markets work. After years of punishingly low prices in the uranium part of our segment, nobody was meaningfully advancing projects. Exploration budgets collapsed, advanced exploration projects were shelved, and then we started to see tier 3 production shut in, and then tier 2 production shut in. And then, of course, a couple of years ago, we shut down the largest, highest grade mine and mill on the planet, all because our market was oversupplied, not in absolute terms. Our market, primary production, has not met primary demand for about 30 years. The reason our market was oversupplied is because term contracting dried up after Fukushima. So it was the forward business that suddenly went on strike. And as that forward business went on strike, we saw folks who were producing from assets and didn't have a home for it sell into the spot market. That pushed prices down, and we saw the corresponding collapse of the supply side of our business. So here's what's pretty exciting for us. We're in a market that's beginning to recover. We're seeing demand come back. We're seeing utilities begin to contract, but they're not even at replacement rate yet. So utilities around the planet are consuming more off old contracts than they're coming in to replace. That's a pretty exciting situation because it means we're in the early innings of one of our security of supply-driven contracting cycles. The primary supply stack isn't poised to respond. We don't have those secondary volumes that have filled the gap in the past. We've never been at this stage of a cycle at a $50 uranium price already. So what's required to fill the gap? A higher price. We just have to start developing projects that globally are today resources in the ground and need to be converted into reserves, which requires that pesky economic model, which means prices have to go up. And then we'll see the investments. For prices to go up, we need to see more contracting. It's as simple as that. The resources are there. The reserve base isn't at today's prices. It's all suggestive of a very bright future for uranium.
And let's just touch on that contracting cycle. I mean, one of the focuses, unfortunately, from investors is a focus on the spot price, and because it's observable, contracting is not so observable, and you get that double-edged sword there of sort of people wanting to respond to that, and the sput's obviously been instrumental in that. But to your point, 99% of what goes on in this market is in the contracting cycle. And it's through the nuclear fuel cycle as well, with conversion enrichment to the next stages. Can you give us a little bit of a rundown there? I mean, last year was a good volume year. It was one of the first pickups we've had since 2011. But where does that go? What are you seeing? How are utilities approaching this to really see through this cycle to give them that supply that we need in the future?
If there's any message to take away from today's talk, it's that the uranium business is not about the spot market, as Guy just said. It is so important for an investor in this space to remember that having a good asset is a necessary but not a sufficient condition for creating durable cash flow and earnings in the uranium space. you also need a marketing strategy. You have to have that asset ready for the market when somebody actually wants your product. And what we've seen time and time again is folks have entered the uranium production space with a spot strategy. And why is that no good? Because utilities do not use the spot market to fulfill their run rate requirements. They use it for very small discretionary volumes. So for example, last year, 2022, apparently 60 million pounds went through the spot market. Seems like a big market. Only 13 million pounds of that was actually utility demand. Utilities enter the long-term contract space, and those who produce to dump into the spot market just take money out of your pocket as an investor and put it in the pocket of the utilities. So therefore, you really have to focus on the term contracting. The term contracting is cycle-driven. Utilities tend to sit out the market together. But the good news is they then tend to enter the market together. So I said earlier, we're sort of in the early stages of one of these term contracting cycles, driven by the fundamentals. Pretty obvious that when you're starting to require material out at the end of the decade, you've got mine depletions, you've got the failure of investment. That's all suggesting it's becoming more scarce. And now we have a major geopolitical event in our industry. Russia has been a very reliable supplier of nuclear fuel to the Western world for decades, and suddenly we find them on the outside trying to look in. They're responsible for 14% of global supply of uranium, 30% of the global supply of conversion, and 40% of the global supply of enrichment. So as utilities in the West today are looking to get out from under their dependence on Russia, they have a smaller set of Western capacity to contract from, and therefore the contracting is coming back. So it's not a spot market, it is a term market. Pay attention to the uncovered requirements wedge. That's the stock of demand that has to come to the market to fuel the known reactor base, and then ask the question about the rate at which they're coming back. Last year, 114 million pounds consumed in our industry, bought forward in the term market out of total consumption of 180. So utilities are not even at replacement rate yet. This is the beginnings of a cycle, but pay attention to the term market, not the spot market.
And you touched on conversion and enrichment, and for those in the room that don't know what that is, uranium's different to coal and gas, for example, where the coal that's pulled out of the mine is put on the ship, put in the furnace and built. There's a 2-year mine mouth to reactor core process where that yellow cake that comes out gets converted, then enriched, then put into fabricated fuel rods. You guys are playing an instrumental part in that, and we're seeing very high prices in the conversion and enrichment space. But I think, as you've said in the past, it's no good these utilities booking the second and third and fourth stages if they don't have the raw material. Are you seeing that coming through and with respect to your conversion conversations?
Yeah, there's no question. The other thing to take away is the way utilities behave in our industry. So our utility customers start downstream and work their way upstream. So for many years, they'd been very happy buying enrichment and conversion services from the Russians. And then, of course, with this geopolitical realignment, they've had to turn their attention away from uranium and go back downstream. So now we've seen the enrichment price rise considerably as they look for Western enrichers to replace Russia. The conversion price, which is one of the intermediary steps, is at historic levels. Conversion price has never been higher. We're delighted about that because we're a converter. We have the only North American conversion plant operating at the moment. It's very exciting for us. And then what happens is once they've got their services lined up, then they go and look for the product because they know where to send the product around the planet to get all those services applied. So when I say to you that there's a demand bulge that's coming, it's not because I'm sitting there hoping it's coming. It's because I'm seeing it go through the enrichment space. I'm seeing it go through the conversion space. It hasn't yet turned up in the uranium space. It will, it has to, because utilities today are now far more contracted for conversion and enrichment service than they have the product going in. That bodes well for that catch up in the uranium segment.
And you touched on the geopolitical realignment happening as a result of the Russian aggressions, causing a pretty big energy crisis, not just in nuclear. how has that changed in discussions with your clients? You know, there's lots of talk about utilities looking to self-sanction because governments so far have not done that. You're seeing that proactively as they're looking to for more energy, the diversity of supply?
Yeah. There's two dimensions to it. It's not only the utilities that are part of our traditional customer base, looking on a go-forward basis to exclude Russia. We've actually had the appearance of a brand new market for Cameco and for an acquisition that we made, Westinghouse, down the fuel chain. And that's Central and Eastern Europe. Central and Eastern Europe, from Finland all the way down to Slovenia, has a lot of Russian-built reactors. And what was common about that market is the Russians just brought a fabricated fuel bundle to those markets. Already had the uranium in it, the conversion, the enrichment, the fabrication. Russia invades Ukraine. We've got a region the size of South Korea that suddenly showed up overnight. We don't get demand that just suddenly shows up like that. It's pretty exciting for the nuclear industry. And these countries are looking to very rapidly move away. So we've got the existing customer base looking to diversify away from Russia on a go-forward basis. At the same time, these new customers are showing up. And it's a fascinating conversation because in our existing customer base, you know, some of the fuel buyers would say, you're not going to sell uranium in conversion to that Central and Eastern European market, are you? And absolutely we are. If you want to get in line, you better start contracting too. And probably the best example is we just announced several weeks ago that we have 100% of Ukraine's fuel fabrication and reactor fuel business. So Ukraine has 15 reactors. It's a huge market. It's the biggest market in Europe outside of France. And 100% of the uranium needs and conversion needs are coming from Cameco, and 100% of their fabrication needs are coming from Westinghouse. And we love that effect because now the rest of the customer base that thought they were getting that uranium and they were getting that conversion and fabrication are suddenly saying, well, what's left for us? We'll come contract and we'll find out.
And Brookfield, Westinghouse Electric, that transaction, pending approvals, obviously, the fact that your joint venture partner is Brookfield Renewable Partners, you know, one of the biggest energy transition renewable energy investors in the world, 125 gigawatts of projects under development or in production. They've just basically taken this whole sector and shaken it by the shoulders and said, hey guys, nuclear fits our very, very, you know, tight investment parameters. How are you finding those conversations changing? I mean, obviously here we're outside our echo chamber, and I'm assuming that's happening a lot more as people are saying, this nuclear thing, we need to understand it if the biggest investor is ticking the box that it's acceptable.
Yeah, of the many things we like about our acquisition of Westinghouse and the continuation of a vertical integration strategy that has driven value for our owners for decades, one of the things we liked, quite frankly, is Mark Carney and Brookfield Renewable taking nuclear from the fringes of the clean energy debate and dropping it right in the middle with a global investor base that had already plowed into their funds. They raised $15 billion the first time. They've, of course, announced raising another $20 billion for their second clean energy transition fund. We've talked forever and ever about the role that nuclear needs to play in clean energy, but we're a nuclear company, so people always took that with a grain of salt. When Brookfield Renewable said it belongs at the center of a clean energy transition, that's a different conversation. So what we have right now is an origination or an initiation in our investor relations group that's never been higher. We've never had this many new calls. We've never had this broad of a base of investor come to us. A resource investor who wants to understand the fuel cycle, an energy investor who wants to understand the fuel cycle, an infrastructure investor who goes, oh, I didn't realize that you sold uranium under long-term inflation-linked contracts. I kind of like those. Those are sort of infrastructure-like. So the whole conversation is absolutely changing around the role of nuclear. And it's the investor reaction that's actually out in front of policymakers right now, which gives us a sense that there's a durability that maybe has escaped this industry in the past.
And what's happening with the investor base? I mean, there's so many catalysts in the space. You've named a whole bunch of them. We've got government support. We've got green groups accepting nuclear. We've got, incentives to keep nuclear reactors operating longer. We've got one of the biggest reactor build programs in decades. The price is holding up. We've had a big energy crisis. I mean, what do we need to what's the catalyst that's going to get investors rushing back in and sustainably moving this sector forward, as opposed to in and out in a meme trade?
When we shut McArthur River down in the lulls of the industry, it was $17.75 per pound of uranium. Today it's 50. So the first move has already occurred, that piece where you bring back to production economics. The second move that hasn't occurred yet is where you bring back greenfield. And so there are folks that are saying, I just want to see the contracting for that greenfield space driving prices. And I understand that temptation, but let me just caution you. When it moves really quickly in this business. So the folks who have always said, I'm just going to get the timing right, and I'm just going to invest the moment we move to greenfield pricing, are usually the folks who say, why didn't you tell us it was going to move? Because it moves really quickly, because it tends to be shock driven. There's usually a security of supply event that finally pushes them across the line. I don't know what that will be this time, but things like sanctions on Russian material or a voluntary export restraint by the Russians, you could go back to the 06-07 price spike, which was a supply-driven event. That would be analogous to what would happen to the fuel cycle when that kind of shock shows up this time.
All right, and so I think we've got about a minute left. Any closing remarks? Is there anything that we need to get out to the audience here, into the greater ether?
Well, just obviously the point that if you're interested in uranium, good on you, because you should be. It's a pretty exciting time. It's pretty constructive. We haven't seen this confluence of events before. And, there are ways to play it. We're obviously one of them. But just, it's not a commodity. So do your homework, talk to Guy, understand the market, come see us.
Just invest in my fund. That's the way to do it. So yes, Cameco, they are listed in the US exchange and the Canadian exchange. They're a key friend of Tribeca and have been a significant part of our portfolios over the years. And so we'd like to thank you, Grant, for making yourself available. I've got to say I was very excited to have this opportunity, and I think it's been wonderful. I hope we've all helped some of you along on your educational journey, and see you in the space soon.
Thank you.
Thank you, fellas. Now you have to take your chairs with you. No, not really. I've got a minion to do that. Where's my minion? This is Marcus, the minion. Thank you so much, Guy. Appreciate it. And thanks very much to Grant as well. All right, next up, we're going to the world of lithium. And this particular company had not one, but two dots on Joe Lowry's little map this morning. Thank you, Marcus. One of them is in Argentina. It is 100% owned and it is advancing towards production. It's high grade, it's low impurity. And the second one is in Greenbushes in Western Australia, also 100% owned, and it is adjacent to the world's highest grade spodumene deposit. This happy fella here, for many reasons, is JP de la Vega, and he is here to update us on Galan's very exciting journey so far. Would you please make him welcome?
Well, thanks very much for the kind introduction. My name is JP Vargas de la Vega. I'm the Managing Director and Founder of Galan Lithium Ltd. I'm very excited to be here in Singapore. This is my first time ever here, and in the last few days, I've been talking to quite a few people from Singapore. They've been very welcoming, so I'm really pleased to be here. So thank you for that. Now, about Galan. I have got 20 minutes to give you an update where we're at. And the most important thing the message that I'd like you to take from Galan is that in 2 years' time, Galan will be a lithium producer. So we are working very hard. We're rallying the troops. We're working at all fronts to get into production. We understand, and there's a deficit in production, there's a deficit in the long-term future, and we want to take advantage of that while the prices are high, and we want to strike while the iron is hot. Now, this picture that we have here, it's although it's very simple, there are evaporation ponds at the Ombra Muerta West. It has taken us a little while to get there, but now we are almost about to give results from our evaporation ponds. And itself, and so this is, here we are, sorry. What we're doing and moving rapidly is into production, as I mentioned, and the picture is showing where we're at. But Galan is very different to the usual salt flat that you have found in Argentina. And why is that? We have probably the highest grade project in Argentina, with one of the lowest grade levels of impurities, and probably one of the least variable ones. And this is a key important aspect when you come into production. And why is that? When you come into production, and simple rule of mining, you have, even in a hard rock, you have high grade, low grade, you need to blend your rock and then put into your processing plant. Nature has given us a gift in the variability of high grade, low grade is pretty much almost the same. In other words, our brine goes straight into the ponds, into the concentration, and we don't have to play much with the variability. Why is that important? The reason why it's important is because you have a known flow and known grade, known impurities that will follow a trajectory into the concentration path that the evaporation route gives. And importantly, you're not losing lithium. In other words, your recovery grades are very high. So there are plenty of examples with other salt flats that the variability is quite high. We don't find that. And we're very pleased with this gift of nature that keeps on giving. Now, this is a picture of what we have. And we have today 5.8 million tons of lithium carbonate equivalent. How big is this if you're not familiar with lithium? If you've seen the news last week, our resource is at Hombre Muerto West is equivalent to Liontown's resource by 100,000 tons higher. Overall, it's bigger because if we add Candelas, then we have 6.5 million tons sitting on the ground. We're going to come up with a resource update very soon that will increase a number. It is important because we have the resource, we have one of the highest content of measured into our resource with the highest grade in Argentina. So we're lining the ducks in such a way that we are going to be producing, not only because we have the grade, the tonnage, and importantly, we have the people. And I'll come back into that in a minute. So how are we going to get there? Well, we have, in October, we launched our permits for, I'll call it our stage 1 development. We're going to come up with a DFS sometime late this month or before if we can. And we have a development that have 2 stages. Stage 1 is 4,000 tons of lithium carbonate equivalent in lithium chloride. Physically, that's 12,000 tons of lithium chloride. And we are on the cusp of a transformation point to production, as I mentioned earlier on. We have launched the permit that we believe that are going to be granted this quarter, the second quarter of the year, calendar year. We're coming up with a DFS within the same time frame. We're going to be launching also our large development permits, and that is a combination with after the DFS. So we have a lot of things going for us. And then the second half of this year, we're going to have the execution of these 4,000 tons. 9 to 12 months of construction. As we construct the first pond, imagine you're constructing the first big pond, you start filling that pond. So the process of evaporation takes around 9 to 12 months, give or take, where you start your production and your evaporation process. Our expectation is that by the first half of 2025, we should be getting cash flow from these 4,000 tons. This is our first steps going into production. We're going to grow from then, but we want to grow in such a way that it doesn't affect. CapEx for this 4,000 ton development should be sub $100 million. And that's very important because we're not going to come out with big numbers into the market to scare them with our CapEx requirement. But we can do something organically, we can walk before we run, and then we can start with 4,000 tons and then increase that into the future. Why are we doing lithium chloride instead of lithium carbonate? We're doing lithium chloride because we get to market quicker. We get in 25 instead of 27. A lithium carbonate plant will require working capital for 2 years, and we're not going to get paid. So we want certainty. We want to walk before we run. And importantly, We want to be a mining company, and we can be a mining company by producing lithium chloride concentrate. If we are a lithium carbonate plant, if we have the carbonate plant, we'll become a lithium chemical producer. So it's a very different thing. And if you've seen other companies that tried to do this in the past, it shows that things are not that quickly done. So we want to walk, then we run. We want to mature the project. We want to keep our CapEx low. We want to be able to become a lithium company because we have people ready to execute this. This is a snapshot of a market cap where we see it. Top 20 shareholders has got 51% of the company. I know most of them, those top 20. And I'm seeing local shareholders here in Singapore, which I'm very pleased to see. Directors and management's got around 13%, and we have cash to finalize our study that we're doing at the DFS at Hombre Muerto West. We have budgeted 3 more wells. We finished well number 4. We'll have 6 production wells that can produce anywhere between 8,000 to 10,000 tons already fully permitted. Now, what do we have to go for us? We are in a downturn and we have the opportunity to grow in value. And this is my invitation to you to participate at Galan at a point in time when we have a very mature project compared where we've been to for a re-rate. This is a timetable of the things that we've done. Importantly, what we're coming here is permits again, 4,000 tons. We're going to execute in the second half of the year. We're going to become a producer in the first half of 2025. So summarizing where Galan is, we have a world-class location, as I mentioned, high grade, low impurities. We have compelling economics that I'll show you in a minute. And we have a way of doing this in a very simple way that doesn't require a lot of energy and doesn't require fresh water. The key thing is fresh water. People talk about water loosely. The point here is fresh water. We're evaporating our brine and we require low amount of fresh water to use for our processing. Most of the water, the fresh water we require is for the camp, for the people that live at the camp, and to clean some of the piping. And that's pretty much it. And lastly, to add dissolved lime into the liming process of adding to the brine to separate the impurities from the chloride. And this is a key thing because we're using the sun to our advantage. The sun is there for free. The sun is not going to charge us, and we use plenty of sun that we have. Just to give you a reference, 60 millimeters of brine, so 6 millimeters of rain we have a year. So if you are in that part of the world, you'll be happy to see a cloud. So we don't have much rain, and something probably that doesn't add up here, but in that part of the world, at 4,000 meters at the Andes, the tropic, on the other side of the Atacama Desert, the rain is very low, and we're using the sun to our advantage. So next thing is that we have a fantastic team, and we have probably the best people around to execute. And I don't say this loosely because it's just Galan. No, it's because of the curriculum that these people have that can execute into the next step. And beyond, we have a pipeline of projects that can make Galan a larger developer, a larger producer down the track. So a map of our operations, or where the operations will be, we are located at the Lithium Triangle. You hear many times where the Lithium Triangle is. And we are next door to POSCO, Livent, and Allchem. So these are big companies that are operating there. The good thing that we've been able to do is to demonstrate that we have high grade, low impurities, and the resource keep on growing. So just to give you an idea, we will have a similar size project in terms of the volume that it has, that Allchem has. And if this was a barbecue like you'll do in Argentina, we could say that we have the best barbecue in town. And why? I'll show you in terms of the chemistry. But this is just a reference of the salt flat of Hombre Muerto. And I will say that the picture you see there, you can fit Singapore easily in there. So 700 square kilometers, more or less, is the size of the whole picture. So the salt flat of Hombre Muerto, it is not a small place. So here's the chemistry. We have high grade, low impurities, and to your right, you have grade. So on the axis, on the bottom axis, we have grade. So the further to the right you are, the higher the grade of the resource. Galan is at extreme right. Now, what you see on your left is a mix. So it's a ratio of magnesium to lithium. So the lower you are on the screen, the lower the impurities. That means that our starting point is probably one of the best in Argentina. And if you look next to it, you'll see Livent, you'll see POSCO, and also you will see Allchem. So pretty much, in other words, I'm saying the brine of Hombre Muerto, they're all cousins. They're all very similar in terms of the chemistry and with the highest grade. So some people ask me, why don't you do DLE? DLE has been around. Well, we are in the middle of the Andes. We don't have plenty of power. We don't have plenty of fresh water available. If you look at Livent's expansion plan, the third expansion plan is ponds. And they say, why? Low capex, low water consumption. So we are doing what we know we can do with high grade, low impurities, that's proven. And we don't want to reinvent the wheel, because we know that the current technology that exists, it is not necessarily amicable where we are to produce lithium chloride concentrate without, or carbonate, whichever you go, without a high input of energy and low uses of fresh water. And that's a key important point. Now, we have 100% of the Hombre Muerto West, both projects, we have them 100%, and there is no royalties to a third party. So this is as clean as it can be. You can see some of the metrics that we did on the previous PEA. Our next study is going to come for the lithium chloride solution only. And why are we going through lithium chloride? Once again, I refresh you, is because we're coming online on 2025, cash flow earlier. We're going to be using less capex, and also we require less working capital and less uncertainty in the project delivery. So we have the piloting has commenced at Hombre Muerto West, as you see in the picture. It's a beautiful picture of the salt flat. We have results coming up in May for the confirmation of our target of 6% lithium concentrate in the lithium chloride. Now, if this was lithium oxide that comes from Australia, where most of the lithium comes from, that will be approximately 12% lithium oxide. So there's not 12% lithium oxide out there. Joe, Lowry call it liquid spodumene. We believe that we can place this within Argentina. So the economics for a 12%, if the Australians can do it with 6% or maybe less, we can do it with 12%, no problems, and make it very profitable. The same thing, we have our second project, Candelas. We've done a study, it's all compelling, and I'll come into the next one as why this is very important. As more producers come into the industry, the tail of that cost curve is going to increase. We're going to be remaining in the first quartile or in the first half of the industry. No matter what happens, if there's a crisis in the world, COVID number 2 comes in, we want to get online, because once we start producing, no one is going to take us out, because the lithium industry pretty much needs to collapse for us to be out of the equation. So why lithium carbonate, why lithium chloride, and why we're going to go in that way? As I mentioned early on, the ESG credentials are very strong. Why we use the sun to advantage? Plenty of sun there at Atacama, put a lot of sunscreen because radiation is quite high. There's no coincidence, a lot of observatories in the vicinity as well. We have a very strong commitment with the local community, and then I've been part myself as a company founder, trying to make this work, to make a difference to the community. We are actively been doing, even when COVID hit, we donated respirators that were highly needed for people that had COVID. People forgot about COVID, but we were there. We bought respirators from Argentina, and we've been, in the second picture, we are with the governor of Catamarca. We're doing a donation to the local hospital of Antofagasta de la Sierra, which is the closest hospital unit close to our operations. And the Catamarca government asked you to have 70% of the labor force from Catamarca itself. We are doing that throughout all our operations and people that we have at camp, but we're also doing this in a way that we want to empower people down the track. We are putting more effort in to get this online, and the female force is around 30% today in Argentina of participation. So we're quite proud of our achievements and where we are going. So more about the ESG. Now we are coming online in 2025, and we have kicked several goals to get there. So we're going to be executing in the second half of this year. We have a few alternatives of funding, and we're trying to preserve shareholders' value the best we can. So about our board, we have 4 board members today. We have Richard, myself, Daniel, and Terry. Chris has been joining us since day 1 at Galan, and he's stepping down in May. And Claudia recently joined SQM. She was from SQM in the past, worked with Adam Finayton for a number of years, knows the project very intimately, and she's been adding a lot of value into all the study and the processing that we've done. So I couldn't be happy with the team that I have at the board level. But importantly, we just got Juan Carlos Barrera. He was the Senior Vice President of Operation of SQM. 2 senior VPs from SQM, hydrogeologist that is our geology manager. We have people that have been there, have experience, and we are pointing on track to become a producer in 2025. So it's all happening in Argentina, but as an infomercial, this is not all. We have green bushes, we are drilling, and we're going to come out with the results of our drilling campaign sometime May, June, all depending on the lab. So the labs are quite busy. We have something that is south of the green bushes mine. So this is our first go. We have plenty of targets, so this is not the only one. So this is the only one that we could do quite quickly and get online very to production. To drill to get our exploration going. So in summary, production, high grade, low impurities, fantastic team. We're going to get there, and see you in 2025 when we are in production. We'll be a very different company. So thank you very much.
Thank you very much, JP. Right, everyone stand up, please. Everyone please stand up, because I've seen a couple of you yawning, and that's made me yawn at my desk, and I don't wish that to happen. Can you flip the house lights up for a moment, please, Sharon? So I can see everyone. I know there's this technique called the Pomodoro. So those of you that are involved in business or who are Italian will know what a Pomodoro is. It is a tomato, correct. And why was this technique called the Pomodoro? Francesco Cirillo, who invented this technique about 30 years ago, 40 years ago, he invented it. He named it after the timer that he had on his kitchen bench, which was shaped like a tomato. So if you're not going to stand up, if that's not what you're going to do, okay, that's fine. Just have a big stretch for me. Come on, do it. I'm doing it. I'm looking silly enough at the front. I hate looking silly by myself, and just stretch over one side. Because the idea is that we refocus our brain. And if we refocus our brain, I like these people. Where are you from? You're very well behaved. Yeah, they're very good. Are you Singaporean? No? You couldn't be Australians. We don't follow directions at all. Okay, it's a true story, unfortunately. All right, so what we've got left to do today, we've got 2 fantastic presentations. They have 15 minutes each. And then we have Mr. Lithium coming up here on stage. And we know how, is he in the audience, just in case I say anything? But we know how fast Mr. Lithium speaks. And he is between us and drinks. You don't mind, do you? You'd rather hear Mr. Lithium. I'm looking forward to hearing Mr. Lithium as well. So that's a whole panel discussion. It's going to last for half an hour. So let's get, who are we going to get up here next? We are going to get Sayona. So Sayona Mining Ltd is our second last company presentation in this auditorium. They are powering the clean energy revolution with North America's leading lithium resource base. Now, in March, which was not that long ago, they restarted lithium production at their North American lithium operation in Quebec in Canada. And they've got more expansion planned. You're hiding down there, Dougal Elder. Come up here on the stage. Everyone, would you please put your hands together for Finance Manager at Sayona, Dougal Elder.
Thanks very much for that warm welcome, Chrissy. It's great to be here in Singapore, and my name is Dougal Elder, and I'm the Finance Manager at Sayona Mining based in Brisbane in Australia. And I look forward to sharing with you some exciting news coming down the pipeline for Sayona in 2023. The headline for Sayona is that we are North America's newest lithium producer. We are the first and only significant producer of lithium in North America for some time to come. Production first commenced around 4 weeks ago at our flagship North American lithium mine in the Abyssinian region in Quebec in Canada. NAL's path is now to ramp aggressively over the next 6 months towards a targeted nameplate of 226,000 tonnes of spodumene concentrate per annum. And we think that NAL will get there around Q4 of this year. So we look forward to hitting that targeted run rate around October and then holding the plant there over the years to come. Powering the electrification transition in North America requires two elements: speed of tonnes to market, which we've delivered through the restart of NAL, and the second element is the size of resource base. Sayona has the largest hard rock lithium resource base in all of North America, with a 1/3 share of the total known lithium resources. To put the blue bubble on the right in context, the average of our peers in North America is around 20 to 30 million tonnes. So Sayona is around 3 times bigger than our average peer. And we're not finished there. In the coming weeks, we will announce a resource upgrade for our big growth project, Moderator, which is expected to move that blue bubble further to the right and higher up the grade chart. So continuing to build out our base in terms of the resource base that we already have in North America. Overview of Sayona. We're a $2 billion ASX listed company, part of the ASX 200 index. We were added to that index in September of last year. And to put that in context, around 2 years ago, we were a less than $50 million company. So we've had a very rapid rise over the past 2 years to the cap that we're at today. We've got there on the back of our retail shareholder base. We have over 60% of our register, or over 42,000 shareholders are retail shareholders in Sayona. In terms of balance sheet, we have over $90 million of cash on the balance sheet today. And that's on top of another $50 million Canadian that we've just raised through the Canadian flow-through share scheme, which is purely for our exploration activities in Quebec over the next 12 to 18 months. And more importantly, the business currently has zero debt. Experienced board and management team are guiding Sayona, led by Managing Director Brett Lynch. Brett, together with directors James Brown and Alan Buckler, first started their careers together mining a thin seam coal mining in Ipswich in Queensland for New Hope Coal Corporation. James and Alan also have significant lithium development expertise, developing the mine and concentrator for Altura Mining, which now forms part of the Pilbara Minerals asset suite. Given that lithium is going to play a substantial role in the decarbonisation transition globally, ESG is very important to us at Sayona. The big factor for us is being based in Quebec. We have access to the government of Quebec's hydro grid, which gives us clean and cheap hydropower to run our manufacturing facilities in the province. The other part of ESG that we spend a lot of time on is building transparent and strong relationships with First Nations groups and local communities in which we operate, because without their support and those strong relationships, our projects won't be able to reach their full potential. Quebec. So we see Quebec as a fantastic jurisdiction in which to operate, and there's a number of reasons for this. Being adjacent to the US, you can deliver lithium and lithium products into the US on a lower cost per tonne basis than any other jurisdiction around the world. I've mentioned Quebec's hydro grid, which provides significant cost of production advantages, as well as a 6-star ESG rating on the products that we are sending into the electric vehicle markets in the US. Quebec is a gold mining province. There's over 100 years of gold mining history in Quebec, which lends itself really well to transitioning into the mining of critical minerals. There's a very high quality resource base, a deep pool of talented labour in Quebec, and we've been very fortunate to secure a number of talented resources out of the gold mining industry. There's a well-established infrastructure base in Quebec, well-established power, road, rail and port infrastructure, which gives you speed of tonnes to market. And finally, political support. The government of Quebec has a strategy about building an integrated battery metal value chain from mine through to processing to downstream conversion and then cathode and anode plants, all within the province of Quebec. Sayona has aligned ourselves to that strategy with the government, and we think that operating a full end-to-end value chain model will give us resistance against future price decreases if they happen. So when you add all those elements together, we think that's a winning combination, and that's why we're so bullish on the province of Quebec. If we zoom in on our hubs, Sayona's running a dual hub strategy in Quebec. We've got a hub in the north, cornerstoned by our big growth project, Moderator, and our southern lithium hub called the Abitibi hub. We zoom in on that one first. Abitibi is cornerstoned by NAL, which entered production 4 weeks ago. The only major producer in North America. NAL was a brownfield mine plant and partially constructed lithium carbonate plant that we purchased out of administration 2 years ago from the government of Quebec. The Abitibi hub has a resource base of 119 million tonnes at 1.05%, and we've got further drilling ongoing this year to grow that resource base even further. Ultimately, NAL's destiny is downstream, given that there is a half-built carbonate plant already on site. And the goal is with NAL is to produce 23,000 tonnes of lithium carbonate by the end of 2026, leveraging that half-built plant that's already in situ today. If we turn our attention to north, Moderator will be the big growth engine for Sayona, and it could be multiple times bigger in terms of production than NAL. It's currently a resource of 12 million tonnes, and we will be releasing a resource upgrade in the coming weeks, which will potentially grow that resource significantly from the current resource base. Ultimately, our ambition with Moderator is to produce 100,000 tonnes of lithium hydroxide from Moderator or the Northern Hub by 2030. So significant amount of production greater than NAL. NAL represented a unique opportunity for us, which allowed us to bring tons of lithium to market quickly. We've done that in 2 years from acquisition at a low cost of $200 million. We bought the plant for $100 million, and we've spent $100 million investing in critical areas of the process plant that were addressing some of the challenges of the past around optical ore sorting and magnetic separation to deal with the iron content of the host rock. We've delivered the NAL restart on time, on budget, which is unique in the current environment. And ultimately, with our production path with NAL, we're expecting production of between 85,000 tonnes and 115,000 tonnes of spodumene concentrate between July and December of this year. That translates into shipments of 20,000 tonnes over that same 6-month period, which is 4 30,000 tonne shipments starting in July of this year. So as I mentioned, we've got saleable concentrate on the ground today. We've got over 2,000 tonnes on the ground, which is far more than what we expected at this point. The NAL has produced concentrate anywhere between 5.4% and 6.04%. So we've demonstrated that NAL has the capability of producing 6% standard. But what we'll do is we'll produce at a grade that allows us to maximize recoveries and therefore maximize gross margin to the joint venture. And ultimately, NAL is on track to become the first and only integrated lithium carbonate producer by end of 2026, from mining to processing and downstream. The NAL joint venture has multiple paths to market. The first one is a offtake agreement with Piedmont Lithium, who are also a 25% shareholder in the joint venture. NAL will sell 113,000 tonnes of spodumene concentrate to Piedmont per calendar year, or 50%, whichever is greater. That commences the 1st of July of this year. And I think importantly, each shipment will be shared between Piedmont and the other offtake agreement, which we'll announce shortly, which gives NAL exposure to prevailing high spot prices from that first shipment. So we'd expect NAL to generate good cash flow starting with that first shipment in July. The other offtake agreement that I mentioned, we're currently working through the final arrangements on that, but that's expected to give us leverage to prevailing high spodumene prices, as well as potentially control about where the product goes to and who it goes to. NAL's resource base of 119 million tonnes, we're looking to grow that even further this year, commencing with a 50,000 metre drill program starting over the coming weeks. That drill program is fully funded by the FTS raise we did a month or two ago. And that drill program is really around expanding the resource base across NAL and NAL's neighbour, Valley Lithium, which we have a right to earn into a 51% interest in that. And that's really around defining more tonnes at a better grade to feed the existing NAL concentrator and ultimately to produce more carbonate once NAL moves downstream. We have a PFS underway for the lithium carbonate plant, which is expected to be back by the end of April of 2023. And ultimately, we're targeting to get that carbonate plant into production by the end of 2026. So as I mentioned, NAL in production, and the next big point for us is getting carbonate into production by the end of 2026. If we now turn our attention to Mobilan, NAL really is around, speed of tons to market and generate good cash flow. We're expecting around 85 million dollars Canadian of revenue per shipment, for 340 million dollars for the next 6 months by the end of December. So NAL is really around a fast start cash flow theme. Mobilan will be the growth engine for Sayona. We've done over 30,000 metres to the end of October last year. That will be feeding into a resource upgrade in the coming weeks. We've got a provisional ambition to have a resource of in excess of 60 million tonnes this year. And we're about to launch another 50 to 60,000 metre drill program at Mobilan on top of what we've already done to further grow that resource even further. So I think there's a level of confidence that the geologists have around the quality of the Mobilan deposit and what they're seeing. Mobilan is owned 60% by Sayona and 40% with the government of Quebec. So we think that's strategically important to assist with moving through the permitting process quickly, but also any potential future funding requirements that are needed. Mobilan has a PFS for the construction of a mine and concentrator coming back at the end of May of this year, and a DFS at the end of October. So moving very, very quickly, which speaks to the very interesting and exciting characteristics of the ore body. We also have a regional exploration opportunity at Mobilan with over 1,000 square kilometres of unexplored land purchased last year from Troilus Gold Corporation. So the timeline for Mobilan, we've got the resource upgrade in the coming weeks, PFS and DFS in May and October of this year, and targeting first production of spodumene concentrate from Mobilan by June of 2027, and ultimately our ambition of 100,000 tonnes of lithium hydroxide from Mobilan by 2030. So what does this mean? Sayona has the largest footprint in Quebec with over 200,000 hectares of land across our Abitibi and northern hubs. We have a resource base in the south of 119 million tonnes and a target of growing Mobilan in excess of 60 million tonnes. So we already have the largest hard rock resource base, and we have plans to grow that even further. Production this year from NAL for the first 6 months of FY24 of between 85,000 tonnes and 115,000 tonnes, targeting that run rate of 226 by October of this year. And what does all this mean for investors? Well, we have lots of news flow coming for investors this year. Starting with NAL, we have news of the additional offtake agreements, first shipment in July. We then go downstream with NAL with the PFS due at the end of April, which we expect will deliver very good NPVs, a DFS by the end of the year. And then we swing north to Mobilan with the resource upgrade in the coming weeks and the PFS and the DFS. So lots of exciting news flow from Sayona in the next 6 to 9 months. And we look forward to seeing it all unfold. Thank you very much.
Right on, Dougal. Well done. Thank you, ladies and gentlemen. I squeezed it in there, right. We're going to Ghana next, aren't we? We're going to what could potentially be Ghana's first lithium mine. And this fellow here, can you put your hands together for him first up? And Len Kolff, hello.
Thank you.
Right. Now, actually, you've got a very exciting shift because you're just here before the great man himself. So make sure you get all your facts correct, because otherwise he'll talk about you. So you'll be talking about Atlantic Lithium, and he will be talking about perhaps your target of initial production of 6% spodumene concentrate in 18 months, 2025?
2025.
2025. Okay, so this is Len Kolff, everyone. He's here to tell us more about low capex, low opex. It's a project that's making it one of the industry's leading projects worldwide. Please put your hands together.
Thank you. Okay, good afternoon, everyone. I'll promise to race through this, so I won't keep you from a refreshing drink. So I'm here to talk to you about our Awoya discovery in Ghana and our journey as we transition from explorer to developer on what is arguably one of the best undeveloped near-term hard rock lithium pegmatite projects out there. Just our standard disclaimer. So we've made Ghana's first lithium discovery, and we are now on track to build Ghana's first lithium mine. So we're listed on the London AIM. And in September last year, we listed on the ASX, and we've also got another listing, secondary listing on the OTCQX got a healthy cash balance and a market cap today in the order of 300 million Australian dollars. And we've got very loyal shareholders with SYA International Holdings, who've been with the company since it IPO'd in 2014 and supported us throughout our history. And more recently through our joint venture agreement with Piedmont Lithium that I'll get into more detail shortly. So Ghana is, I believe, one of best-in-class projects. Its strategic location within the established pro-mining jurisdiction of Ghana. We're 110 kilometers from an operating deep sea port. It's a sealed bitumen road to get to that port. It's grid power that's fed by hydro. It's a very sustainable project in terms of its very low power requirements and low water requirements, given it's a DMS only process flow sheet. So gravity only process flow sheet. We are not going into flotation. And we've got a very strong representation in terms of a Ghanaian workforce, overwhelmingly from within the communities where we operate. And those things combined have delivered exceptional financial outcomes to the project as part of our PFS that we announced last year. So I'll get into those numbers in more detail, but just high level post-tax NPV8 in excess of $1.3 billion, internal rate return over 200%, and that's a 12.5-year mine life, 2 million ton per annum ROM throughput, and payback of a capital of 125 million in less than 5 months. So this is our vision, a sustainable lithium supply with positive social impact to support the global transition to a carbon neutral future. And I believe it's those unique geological characteristics and proximity to infrastructure that support our vision. So this is where our portfolio sits. You can see where the Sayona lithium discovery was made, which we made in 2017 and announced maiden drilling results in 2018. It's 100 kilometers from the capital of Accra. You can see the ocean standing on top of the deposit, and we're 110 kilometers down the Takoradi Highway to the operating deep sea port of Takoradi. It's a 560 square kilometer portfolio in Ghana, and we also have 2 license applications in Ivory Coast for a combined 1,300 square kilometer portfolio. So this is where our resource currently sits. It's 35.3 million tons at 1.25%. Almost 80% of that is indicated and measured, and the resource has constantly delivered since the maiden resource of 14.5 million tons and growth to 21.3 to 30.1 million tons and now 35.3, and that grade has stayed consistent throughout. So it's a very well-behaved, good continuity deposit. This is key for any hard rock spodumene project. So in the pegmatite space, you want to have simple mineralogy that can deliver a simple process flow sheet. So in our case, the majority of our lithium credits are in spodumene, so we don't have any of the other myriad of lithium-bearing minerals. And importantly, that spodumene is very coarse-grained. So what that means is it's easy to process through a gravity-only process flow sheet. We don't need to go to flotation to get the recoveries and grades we need to produce a spodumene concentrate. It's also very clean. Our host rock is schist, so we don't have issues with high iron content host rocks and contaminants within that concentrate at less than 1% iron and less than 3% combined sodium potassium. And we've also demonstrated that we can convert our concentrate to battery grade carbonate and hydroxide through ANSTO. Location, location, location. So any mining project, logistics is key, and this project certainly stands out in that regard. We're a kilometer from the national highway that you can see there. It's 110 kilometers to the operating deep sea port that now has ship loading facilities built at that site since that photo was taken. And that's a dedicated minerals handling port exports manganese and bauxite, currently only 40% utilization. And we have adjacent grid power that's fed by the Akosombo Dam in Ghana, so hydropower. So those key fundamentals of the right geology, exceptional logistics and proximity to operational infrastructure delivered a very robust pre-feasibility study last year. This was based on our resource at that time, which was 30.1 million tons at 1.26. We're now at 35.3 million tons. It was based on a long-term spodumene concentrate price of $1,200 per ton, so conservative, and an annualized average spodumene concentrate price per ton of $1,359 per ton, so conservative. And you can see there, based on a 12.5-year mine life at 2 million ton ROM throughput, we had a capital cost of $125 million, given the simple process flow sheet, DMS only, that delivered NPV8 in excess of 1.3 billion, internal rate returns over 200%, and payback in less than 20 weeks. So really exceptional economic outcomes. So this was going to be updated for our DFS, which is due end Q2 this year, and that will be based on a larger resource and revised spodumene concentrate pricing. Importantly, we've got a joint venture with Piedmont Lithium. So Piedmont have a right to 50%, they're earning into 50% offtake of our spodumene concentrate. We retain our 50%, which at this stage is uncommitted, and we maintain control of the project. So Piedmont will also earn 50% at the mine level, and they're at 10% at the topco of Atlantic Lithium. So we have a strong working relationship with Piedmont, technical committee that reviews programs and budgets on a monthly basis, and we're sharing learnings in that regard. Working with your communities is critical wherever you are, notwithstanding in Africa. So we work very closely with our communities, especially around employment, training, nurseries, revegetation of drill access and drill pads, equipment, donations, and our ongoing environmental monitoring programs. As a result, we're very ingrained within the community. Over 80% of our Ghanaian staff comes from the communities where we operate, and they all go home at their end of their day shift. So it's not remote. They're all going home to their families. And as such, we've got a very good relationship with our community. So this year is going to see a large exploration program as we advance the DFS towards mine build in parallel. We've got in excess of 20,000 meters of auger planned and 6,500 meters of RC drilling to follow up targets throughout this year, including a passive seismic survey to look for any blind or concealed pegmatite deposits that could be a game changer to the current resource. We've also got 12,000 meters of resource drilling planned to grow the resource and increase confidence accordingly. So what this means is ongoing news flow from the drill bit. From the studies perspective, our DFS is due Q2, the end of Q2 this year. We've already announced an optimized process flow sheet design, as well as we'll be looking at various tonnage throughputs to optimize the project economics given the larger resource. In parallel with the DFS, we're going to commence scoping studies, stage 2 scoping studies, which will look at the potential for early spodumene concentrate production through modular mini DMS plants. So this will allow us to get into early production whilst the mine is being built and the industrial concentrate plant is being built. It will allow us to train our workforce, understand materials handling, and test the logistics pathway. So we're targeting first concentrate production in 2025. We've submitted our mining license application last year, and we hope to be permitted at the end of this year, which will then allow us to break ground early 2024 with first concentrate 2025. So what can we expect in this year? We've got a lot of news flow through exploration and the resource programs that I outlined earlier. We've got our DFS due end Q2 this year, which will incorporate the larger resource and revised spodumene pricing and various throughputs. We hope to be permitted at the end of this year, and we're in the process of building our leadership team as we transition from explorer to developer. And that's it. Thank you very much.
Well, they love you even more. They love the presentation. They love you even more for keeping it short and sweet. Thank you very much. We appreciate that, don't we, everyone? Put your hands together. Give yourself a bit of a workout. I've decided that our hands going together are our workout for the day, Eloise. Right. One more thing for us to learn, one more opportunity for us to put some more education into our weaponry and the things that we know. I'm looking for one Joe Lowry. Have we lost him? Or is he at the back of the building? Where is he? He's down there. Hello. I didn't see you down there. I'm going to hand this microphone to you, sir, and you're going to be in charge for the next half an hour, 40 minutes. You run it as you see fit. What are you? You want me to say that's my job? Okay, fine. I've been told by the God himself. All right, guys, you ready to come on up? Where have we got in the background there? So I have got 4 esteemed individuals. We've got Gavin Lockyer, who we've seen on the stage before from Arafura Resources. Come on up, Gavin. We've got Thomas Krumer, who is the Rare Earth Observer. And we've got Nicholas Curtis. You going to come up for us?
Yes.
Where are you? No? You don't want to be in this one?
No, not that one.
Right. Okay, good point. I've gone to tomorrow. I've tried to fly home already and get to tomorrow night's cocktail party, which I guarantee isn't as good as tonight's cocktail party. Don't you laugh at me, because I saw you yawning earlier on today, and I'll out you to everyone. We are indeed talking lithium. So Joe's in charge. So I need Ron Mitchell from Global Lithium. I need Stephen Miller from Abyssinian Metals. I need Daniel Jimenez Schuster from Galan Lithium. Hello, Daniel. And last but not least, from Geo40, would you please put your hands together and welcome John Worth. I'll give you a call at 5 minutes. Otherwise, run it as you see fit, sir. Thank you.
I don't want to keep people from beverages, so we'll be quick. Gentlemen, my presupposition is that the world is in a short lithium market. So let's hear from my buddy who copied my company name, and I'm not bitter. Let's hear from you. Where do you think we are in the supply and demand cycle, and what do you see for the next 4 or 5 years?
Okay, thanks, Joe. Nice to be kicking off. And yeah, 2 Global Lithiums here on stage. So you were the first, you will always be the original. Look, from my view, look, I've been in this market, 13 years. I've been in the trenches when lithium pricing was at $4,000 a ton. Not many people will recall those days, and I was there, and Joe was there, and Daniel was there. It's hard to get projects up, and there needs to be incentive pricing. I mean, it's my clear view. For the most part, developers such as us are taking all the risk in bringing new units to market. And if there is an unrealistic expectation around lithium pricing, quite simply, the projects will not be developed. It's as simple as that. So yes, I am a believer the market will be short. I know what those challenges are, and each jurisdiction has its own set of unique challenges, even in Australia. I mean, we do things incredibly well from a mining perspective, but even in Australia, there's challenges. So I think working together is key. Governments need to be more proactive, certainly in terms of policy setting, providing really the right direction so that companies like ours and others in the battery metals and critical mineral space can make those investments to bring new units to market. So that's what it's all about. So yeah, stronger for longer in terms of lithium pricing. Yes, there's going to be ups and downs, but I'm a firm believer that it's going to be harder, not easier, to get new units to market. There's challenges across the board, and most of the low-hanging fruit in terms of lithium discoveries, I think, have already been made. There's either a tenement wrapped around the site, or they're in operation. So going forward, exploration is going to be inherently more difficult and more risky.
Let's just move down the line. So everybody's got an expectation that Africa is going to become a major contributor. What are your thoughts on Africa's, what do you think by 2030 Africa can be contributing to the lithium supply chain in LCE terms?
We're one of those groups that Abyssinian Metals. Yeah, so Joe, we're one of those groups, a new group in Ethiopia. There's no doubt, in fact, our project is world class, but it will take longer to develop than most people anticipate. But it is clearly going to be, as a world class project, deliver substantial volumes going forward. As I said, it's a matter of probably no shortage of lithium out there. It's a matter of quality projects. I think it's a matter of finding those quality projects that can be tier one, low cost producers that can sustain, the low downturn of spodumene prices. So, our challenge has been to find one of those, quality projects which Ethiopia happens to have. Our future is actually in its history. It was a world-class tantalum project. So we have, I guess, as a brownfields project that to spring off it. So we think our project actually is quality, and Ethiopia will be a substantial producer long term, providing there's a reasonable spodumene price going forward.
Accepting all that as fact, the question at hand is, if you look at the broader continent, because we got Australia represented here, you're representing what's going to happen in Africa. Daniel's talking about South America. So if you don't have thoughts on the overall ability of Africa, that's fine. But I just am trying to frame a number, because if Albemarle's right and lithium demand in 2030 is 3.7 million tons, we got a really big problem. And I'm just wondering what you think Africa can do in terms of bellying up to the bar with LCEs. No, I'm trying to get a number for Africa.
Okay.
No,
Sure. It gets down to infrastructure, and obviously to get to that production, to get those volumes out there, you need the support of all the stakeholders. Critical to that is obviously the support of the government and all the stakeholders to unlock the infrastructure requirements to meet the demand. So that's the challenge. It's a challenge in having developed lots of projects in Africa a long period of time. It's always been a challenge. It's nothing different to what we face today. Is aligning all the stakeholder interest to unlock those hurdles. Now, fortunately, we've got a bunch of very interested parties that will help us. But again, there is a lead time to that production, and that will only, will only increase the shortage of supply.
just in case people aren't aware, Africa actually has a long, proud lithium production history that goes back longer than I go back. And sometimes that's not appreciated, but the old mine is still running. We've got new countries coming into the fore, but I'm clearly not going to get a number on Africa. So I'm going to move down to Daniel Jimenez. And this guy has been in the industry almost as long as I have. He is a 3-time podcast guest, or is it 4? I always forget. But I'm going to put the same challenge to him. If we've got 3.7 million tons of lithium that's going to be in demand in 2030. Ron's going to give me a number in a few minutes about what he thinks Australia can do as peak lithium. But what do you think Chile can do? Talk about the Atacama. And then, as a proud board member of Galan, tell me the Argentinian story. And usually you don't ask a Chilean to tell you the Argentinian story, but hey, we're gonna break all the rules today.
Yeah. No, indeed the challenge to meet this demand is really very difficult to meet. We have to consider that demand over the next years is going to grow at rates which are equivalent to the total demand in 2018 and 2019. So 300,000 tons and above. So it's not only a resource problem. It's not only a timing problem. It's also a people problem. Know-how is not there. So the challenge is very big. And yeah, I have serious doubts that if the Albemarle forecast, demand forecast is correct, that the world is going to be able to supply this lithium. Having said that, and going to your question, Joe, I think when we think about the producing countries in South America, Chile is probably going to, over the rest of the decade, probably the only feasible production will be Atacama. Atacama might reach levels of 350,000 tons aggregate production between SQM and Albemarle. I don't see that growing significantly more, mostly constrained because of hydrogeological balances you need to keep there. Then moving to Argentina. Argentina is I really guess a Chile, and I envy what is going on in Argentina. We have a pipeline of around 30 projects alone there. And these are projects that didn't start yesterday. They started 10 years ago already. We're now going to see this year the first new producer coming online after 6-7 years. But projects even with this big pipeline of projects, of which a percentage will work and another one will not work, I see Argentina by 2030 probably producing also around 300,000 tons, maybe a little bit more, so equivalent to the size of Chile. So between these two countries, we'll have 600 to 700,000 tons, and then what is left is Brazil. And Brazil is also a very, at the very early stage. We have 3 operations today in Brazil, Sigma coming up soon, the next bigger one in production. But what can Brazil do over this period of time? Yeah, let's be optimistic, maybe 150, 200,000 tons. But that's it. All in all, we have 800,000 tons in South America in a best case scenario, I would say.
One of the greatest potentials for increasing the supply of lithium is direct lithium extraction, which if you were in here this morning when I was talking, I made the case that right now it's just the promise of DLE because there is no commercial DLE as pure DLE. What Livent does is at best a hybrid. So, John, you're talking about doing DLE with very low ppm lithium, as I understand it. Could you just tell us a little bit about what you're doing and when you think DLE will be ready for prime time?
Thanks, Joe. Look, we're an unusual business because we developed a tech to get silica out of geothermal fluid. And in silica, we're quite a mature business. We've got a couple of big plants. We process about 7 million liters of brine a day. We do 4,000 tons per annum. So we're following that same journey in DLE. And because we started in the geothermal world, we pull lithium out of brine in New Zealand, non-commercially, at 7 ppm, right? So we think we lead the low-grade space, and our number is 50, right? So if you've got a lithium resource at 50 ppm, we think we can make that work commercially. And what that does is that opens up Canada particularly and the US. And what's compelling about Canada and the US is that there are projects with brine flowing. There's guys up there with 500,000 liters sitting in a warehouse. They've got flowing wells. They're ready for DLE today, right? And so what you do with DLE is you take the resource side out of it. So you're not constrained by trying to get your licenses in place and all of the build issues there. You've just got to deliver your DLE technology. So we'll do the same as what we've done in silica. We'll scale up. We'll be in the field this summer in the US with a field rig. We're shipping brine lots into New Zealand. And what we're navigating towards is exactly what we've done in silica, sort of 5,000 to 10,000 ton LCE plant. And if you take into kind of 2025, if you take Joe's growth number, which I agree with, sort of 200,000 ton incremental annual demand, DLE can play a role here, right? But the challenge is to find these projects that are attractive, where the infrastructure is in place, and you've got tech that works on those grades. And we think that's a super compelling story. And we've heard it all day, right? DLE is a contest of infrastructure. It's not just grade, it's power, water, fabrication, and so on.
Well, there have been nasty rumors going around that I was anti-DLE, and I just want to, disabuse the audience of that. But let's talk business plan. How long? I mean, you have a pilot, you have a
We have a
couple of
pilot, yeah.
pilots, all right?
Yeah.
So
2 pilots.
normally the protocol would be pilot, demo, commercial.
Yep.
When do you expect your best case guess, not best case scenario, best case guess, on when is the first 20,000 tons from pure DLE? And again, I don't count most of what happens in Shanghai. There is direct lithium extraction in Shanghai. If there's anybody here from Sunresin, we can debate that later. But most of that's using ponds. They claim they'll be doing 50 ppm projects without ponds, but I'll believe it when I see it.
Single site, 20,000 tons LCE.
It doesn't have to be
2,000.
single size. When you did 4 or 5,000 ton plants, when will you get
First
20,000 tons?
Yeah, so first 5,000 ton module, our goal was 25, late 25, and then a multiple of that in 26. So that's kind of our view of how you get a DLE tech to market, and doing exactly as Joe says, right? Nobody goes from the lab to a big plant, right? So we will be in the field this summer with another pilot, demo next year, and then we get into bigger plants.
When you look at you referenced North America, you've got plenty of brine around. But when you start talking about old oil wells, you start talking about what's in the solution. Tell us a little bit about.
So we've done a whole lot of work in the US, from sort of Arkansas down through Texas, up further north and across the border. And I think there's a couple of things going on here, right? So hydrocarbon separation is a thing. You'll have to do it. You have to get comfortable with that if you've got oily brines. I think the switch here is that not all these brines are oily, right? So we've got guys perforating casings in a different part of the strata and actually bringing up brines which are really clean. So don't assume that North America means dirty, oily brines, right? There's actually
I would never assume that.
but there's some very nice clean brines there. And I think they're of course more attractive.
Mr. Mitchell, I asked you last night at dinner the $64,000 question. What is peak LCE production from Australia, being that we are now very reliant on the land of Oz for our lithium? How high can you go?
Excellent question. And look, having worked for Talison Lithium and the Greenbushes asset for the best part of 5 years from 2011, I reflect a lot on the supply demand model that I built in those very early days, and I still maintain and interrogate on a quarterly basis. I mean, that Greenbushes asset was accounting for more than 50% of the world's supply out of one asset. Well, that's remarkable. And that was only 12, 13 years ago. Look, my calculations, West Australia is accounting for about 50% of world lithium supply currently. So that's circa 400 to 450,000 tons, give or take. My view is, if we combine all the forecast projects that are either in advanced exploration that have a JORC compliant lithium resource, and it's hard to get to JORC compliance, I can assure you. We have 2 of only 14 JORC compliant lithium resources in Australia. So if I look at all the collective up and comers, I look at the incumbents that have the ability and the capability, more importantly, from a resource perspective, to be able to expand. My estimation, not guesstimation, is probably somewhere in the order of 1.2 to 1.5 million tons on an LCE basis out of Australia. And that is doing a lot has to go right to get to that number. Bearing in mind, we're currently sitting at 450,000 tons. So it's effectively a 3x increase.
Stephen, we're going to go back and try to get a number out of you this time. So your project.
Yep.
How long and how much?
Sure. So our first production we marked the end of this year. So 80,000 tons of product, rising to 240,000 tons by second half of next year. But that's really stage one. So ultimately, we're on a plan to do by 2026 about 850,000 tons per annum. So this is a very significant mineralized project. So if we can do that, we think there's a few other projects across Africa in terms of Mali and obviously a few others. So there's at least 4 times that I can see in the near term from Africa. But our project in Ethiopia, we think is potential to do at least 800,000 tons of product, spodumene product
And is that offtake open, or are you committed to somebody?
Now, very much our strategy has been, we've committed a little bit for the first 3 years, portion of that, but we've got a very much an open book to see what's come along. We've obviously been approached by a number of parties, but we're just looking and learning at this point in time, Joe.
Daniel, there's always a lot of discussion when you talk about Argentina, about the chaotic economy, IMF defaults, just general cash trap problems, all those sorts of things. What do you view the biggest barriers? I put a map up here this morning about 2030 Argentina, and there's a lot of names on there. There's a lot of projects, and there's a lot of hope that, you know, Argentina catches Chile, or then you both do 300,000 tons or some number. In your view, what's it like to operate in Argentina, and what are the top 2 or 3 issues that could derail getting to that big number?
Yeah, I would say challenges. I don't see really big challenges from a project execution point of view, in the sense that the resources are there, the processes are understood, at least the conventional evaporation processes, which in Galan we're going to follow as well. From a permitting point of view, I've been also very positively surprised about the attitude of provincial governments towards projects. It's really an attitude of how can we help you, rather than what I see in my country, where it says, where can we put problems to your project? So it is very, I will not say easy, but it's very workable in that respect. Now, of course, Argentina has these problems with the foreign exchange controls. We will see how that pans out when we start operating and producing and exporting. But over time, Argentina will have to solve that problem. So I don't see that as something permanent. And furthermore, we have in Argentina Livent, Alchem now operating also, Livent for 30 years or close to that, Alchem operating now for 10 or so. Both of these companies expanding their production, given the problems you encounter on this foreign currency control systems you have. So yeah, I think we will have to live with that, and of course, hopefully that gets solved over time. But all in all, let's say that especially at this stage when we are developing projects, I mean, I don't know of any project which has encountered big problems on the permitting side, on the environmental side, on the community side. So we're moving ahead smoothly.
I think in the program they call this lithium the new white gold, or you know, something cute like that. So let's talk about gold for a second. White gold, not gold. Chile a few years ago put in a very robust royalty structure, shall we say. And suddenly the lithium industry is contributing more to the coffers of Chile than copper. And that is nobody would have ever seen that coming. Argentina now seems to be considering what their neighbor across the Andes is doing. Do you anticipate any tinkering with the royalty system in Argentina? Any thoughts?
Yeah, Argentina has a royalty system, which is basically a flat fee, a provincial flat fee of 3.5% for lithium chemicals. To that, you have to add an export tax, which is 4.5%, if I'm not mistaken. Yeah, and of course, anybody who owns a resource would like to have a higher royalty. I think all in all, the very high royalty structure, which Kolff, which was not the government, it's Kolff, which is government agency, is charging to SQM and Albemarle. Nobody thought that it would generate the income it's generating for Kolff in this case. And yeah, the Argentina then, of course, might be looking at doing something similar. But on the other hand, I think you have also to be pragmatic in these things. And whenever you have, any country has to see against what they are competing. And that's not only the royalty, it's the corporate tax fee, it's the export taxes. And on the aggregate, you have to see, well, where would investors deploy capital? Where would they get a better return? And Australia, Canada, Brazil are probably today much, much better options than to invest in Chile if that royalty structure of Kolff would be replicated in any new project. Now, last year in 2021, there was an intent by the former government to give lithium licenses or international tender for lithium licenses, and there the royalty structure was significantly lower. It reached only 16%, from 6 to 16%. So I think that is within what could be reasonable. But yeah, the 40% which Kolff is charging as Albemarle is probably not replicable, because otherwise any investment would not work out.
Let's move back to DLE. I always talk about DLE from my perspective. It's the big concern I have when we talk about DLE is that if you get 20,000 tons, you do 5 modules, it works. I always say this is not a drop-in technology because it's bespoke. It has to be customized for the individual brines. Do you agree with that? And if you agree with that, how do you see the tweaking going on? Once there's a real DLE commercial success, what's the tweaking take to take it to other sorts of brines?
Look, we think there are really 7 brine types if you try and characterize the chemistry, right? And they're not hard to work out, but saltancy is a kind of a special category on its own. We don't target it. It's pH 2. I built a geothermal power station there years ago. It's tough going, so that's not us. We've worked across the other 6 brine types. So you can imagine they're classic easy salar brines, they're high magnesium lithium ratio brines, they're high calcium brines. Oil field's got a few subcategories. We've worked successfully across those 6, and so if you're working on oil field brines as pre-treatment, right? If your pre-treatment is good and you've got a good DLE process, you can generally apply it quite widely. That doesn't mean your plant is the same. There's still some tweaks to do, but it's why that piloting and demo thing is so important, right? That's when you establish your reagent usage, you work out your cost of pre-treatment, and you pile all that into your PEA, right? So they're not all the same. Anybody who says their technology works everywhere, you should look at them sideways until you've actually worked. And shipping a brine 50,000 miles and testing it isn't that smart either, right? These brines change over time with transit, oxidation states change. So you have to do the work, you have to do the testing, you have to scale up steadily to make sure that you are going to get it right.
Well, now that I've loosened you up, what's the 2030 DLE contribution to lithium supply?
Look, I think the answer is where it fits on the cost curve, and you take the current situation where the cost curve is disconnected from pricing. So that means every project wins theoretically, but it's still a contest, right? It's a contest for capital. So you've got to prove your DLE project is more attractive than a hard rock project, right? To get the same capital. So I think what we do see in the DLE space is that these brines are everywhere. The projects are compelling environmentally in terms of even just at a social level, just the idea of less disruption to the surface. So I think DLE can play a very big role. I think DLE by 2030 should be at 1 million tons, but that needs a kind of half dozen leaders in the space to execute across several projects. So I guess the question is, if you look at the guys at various stages of development, how many of those guys are going to emerge and build big piles of stainless steel, right? That's the question.
So are you saying there's 1 million tons that would be amenable to DLE, or you're saying that it could be 1 million tons of DLE production?
Production. So if the sector goes like hell and the promising guys scale as we think they can, like take the standards, take the ESMs and so on, the sector 2030, maybe a little later, 2032, feasibly get to 800,000 or 1 million tons.
Well, I'm going to officially right now give you the day one optimist of the day prize.
Big number.
Ron, you are now leading a company, startup, taking it into production. How is your life different from when you were in the trenches with Taliesin and Tanchi?
I've never been asked that question, Joe. It's a good one. I'll consider it. I think the best thing about the role I've currently got is, we've got a great team. We've got two incredible resources. I'm a spodumene guy. I have been my entire lithium journey, which spans 13 years. It's a resource I know well. I know where the challenges are in terms of developing the resource. I think what's important in my role is just the autonomy in terms of decision making. I was working previously in some really big companies, and with those big companies comes challenges, clearly. We employ great people to do a great job. My focus really, as part of the leadership, is really bringing incredible talent and retaining that talent and incentivizing the talent. We've got a really highly motivating staff. We're building an incredible culture, and we're attracting some incredible people from big mining, but also from the oil and gas sector. I think there's this new demographic that's emerging in Western Australia that want to be part of the energy transition future. And I'm trying to make our company one of the standouts, and so far so good. We've got some brilliant capability, and I think that'll continue to develop. So yeah, loving the journey, Joe.
Stephen, how much of a challenge has it been? I always say that when you have a project, the team's critical. How hard has it been to assemble the kind of talent you need to move your project forward in the environment you're in?
Very. And to be honest, we're obviously competing for, skills in an upmarket, in Australia. So to get, qualified people into, Africa, into Ethiopia, a new mining jurisdiction has been a challenge. But, I guess the core team that we have got a lot of experience. So we've done a lot of the heavy lifting ourselves. We're fortunate to actually have a lot of expats who, understand our culture. But in this market, when the market's up, it's challenging to get guys to shift in from, Australia into Africa or Canada or the UK. So that is actually our biggest single challenge today, actually, Joe, is actually getting the next layer to help then educate and bring the additional mining DNA into Ethiopia. So it is a massive challenge for us, but one we're actually, we've got a small team helping to build it, but it still represents a significant opportunity or challenge for us.
Daniel, Argentina wine or Chilean wine?
Australian wine.
I mean, we're leading into drinks here, people. Let's just cut to the chase.
No, don't put me in the spot here. I mean, you know what I would say. So.
I know. I thought this is all right. I'm going to ask each one of you, what's a question that I didn't ask you that you thought I might ask you?
Joe, when are you going to take us to court over our name, Global Lithium?
Maybe my trademark will expire. Stephen, same question.
Yeah, how challenging is it to do business in Ethiopia?
Buddy, I've asked you so many questions on the podcast. So
yeah. No, but I would say today the really challenge in this industry is speed of execution. More than the quality of the resource, more than where we're sitting in the cost curve. The cost curve will be completely different by 2030. So whatever project, the quicker a project can be developed, the most likely that will be the one who will be earning, making big returns for the shareholders. So I would say speed of execution today and be on time, which is a big challenge today, is probably the most important thing today. And in order to do that, you need not only the resource, but also good people in doing that.
Last DLE question. Is the first commercial success in Canada or in the United States?
So the United States is 50 different countries, right? Which makes life difficult, right? And I think everybody's waking up to the opportunity in Canada. I think that's starting to look very compelling.
Okay, I'm gonna shut this thing down, but I'm gonna ask any of you guys, do you want to ask me a question?
Where's your favorite location for wine, Joe? I know you like your booze. You got a favourite country where you source your wine from?
Any country that begins in A. No, I do like Argentine wine, but at the end of the day, I will take Napa. Sorry.
We all like our local ones, huh?
Well, Napa's really not local to me. It's a good long hike.
Have you tasted New Zealand Pinot?
Yeah. I've been to all. I have a podcast fan that shipped me basically a case of Pinot from New Zealand. Anything else?
Favorite last book, Joe?
My favorite last
Book.
That's a good question. Right now, I'm reading biography of Shinzo Abe. So it's maybe not my favorite book, but I kind of like the whole cultural dynamic around how politics run in Japan. So that would be my answer to that question. And so I'm closing this. Okay.
Thank you very much, team. Really, really appreciate it. And I appreciate all of your patience as well. I know some of you got to race outside and have some drinks thanks to Intertech. We're starting tomorrow morning at 8:30 in this auditorium. We've got two really good speeches to start us off, including one from Eddie from Argonaut. That's if you've never seen him present before, you just don't want to miss him. He's punchy, he tells it like it is. He's very knowledgeable, and you certainly won't go away without a smile on your face and being educated. At about 9:15, I think we've got our first company presentation in this room, and also over in auditorium 2, a fireside chat, 3 panels.